another negative ending on the JSE today. So after a very nice week last week, driven up by those resources prices, it looks like the tide's turned this week. And it also looks like we're not alone. Other emerging markets also coming under pressure. Does this really illustrate the shift that we've seen from emerging markets into developed markets that people have been talking about?
I would agree 100% with that. I think you're having what I would describe last year as a rebalancing of flows. We had a lot of money going into emerging markets last year. It wasn't just bonds. There was a lot of money that went into the equity market. We attracted some of that. And now you're seeing a little bit of rebalancing as some of the developed markets improve in terms of economic performance, particularly the US. So the US as an economic story looks more convincing. And I think overall people are saying, well, aren't there some opportunities within the developed market that we can exploit, given that the emerging markets are a little bit full in terms of the pricing? So I think you've seen that rotation going on. And so you've seen emerging market currencies come under a little bit of pressure, emerging markets come under a little bit of pressure. It doesn't mean that the story around emerging markets has gone away, that the economics has changed. I'm not buying that story. There's this constant sort of debate about China and a hard landing in China. I'm not buying into that story. All I think you're seeing is a rebalancing of global flows, an important rebalancing that probably ends up with a better mix of global investors.
Okay, so we could still see some of that money flowing back into South Africa. And how about the resources shares? Because that was the story we were talking about towards the end of last year. We've seen resources companies coming out with numbers, and we're starting to see that in those numbers.
Well, I think that is the story so far in terms of the market. Look, from our perspective, the market is quite full in terms of being priced. You struggle to really find a lot of opportunity, and you would struggle even more if you look specifically, say, in the industrial space or the retail space. So from our perspective, you do find maybe some opportunity within the resource counters, again, depending on your view on the rand and depending on your view on commodity prices, which is kind of a global macro story. Our view is that the macros are reasonably okay, that the rand weakens, and that commodity prices remain reasonably well bid, which means some rotation into commodity shares. And I think you've seen that as kind of a theme during the course of this year. Not an absolutely convincing theme, because people keep saying, well, what happens if China slows down? There's a hard landing there. But if you look at the results, if you look at Kumba's results, I mean, you don't get much better than what the results are that Kumba produced.
They more than doubled their profits and a pretty nice dividend as well.
Yeah, if you said to you, as a set of circumstances, let's put this together, how do you get much better than that? I mean, the price is up, volumes are up, and look, costs are rising, but they managed to contain some of that. So all the sort of working parts seem to have come together quite nicely. And if you look at a couple of resource companies, you're starting to see that effect. Now, the analysts, I don't believe, have quite factored in those type of really good numbers or convergence of factors pushing through. And you can see the benefit if you go into an environment where you don't have major disruptions to transport, specifically in South Africa, which we didn't really have, particularly towards the end of last year. We had in the middle of the year, but not towards the end of last year. So if we can continue on where we can get the stuff out of the ports, that's a critical factor. The rand weakens a bit and commodities prices remain well bid, then from my perspective, resource shares are a reasonable place to be. And something like Kumba will come more and more into favor. It's probably not at the top of most people's list in terms of buying into resources, but I think it will emerge during the course of this year.
And yet those shares are closing 2/3% lower today. They did have a trading update on, so do you think that this was already priced in?
I think it was already priced in. Plus there's kind of, I think, in the back of people's minds a question about can this continue? What happens to commodity prices from here? How much supply do you get coming into the market over the next couple of years? There are sort of plans to produce some additional iron ore. So there's all of these factors lingering in the background, and so there's a hesitancy. And I think this news was already priced into.
Would the same go for companies like DRD Gold, also back to profit, 6% rise in production, but we had that record gold price in dollar terms at the end of last year?
I think the same sort of theme comes through, where you're having much higher price, and then you're getting a local production number that's picking up, and you don't have that ongoing disruption, and you put that together in one quarter and you see what it can do. It pushes you back into profitability. And if the gold mines could continue to do that every quarter, given their gearing, they would look quite spectacular. Unfortunately, from a gold perspective, there's always going to be a disruption. Yes, you'll get the odd quarter where you don't have it, but I suspect you'll have disruptions from time to time. Plus the gold price, I don't believe, is going to push much higher. So from my perspective, I think it's a good outcome for them, but not necessarily a sustainable improvement, unfortunately. So, I'd favor platinum versus gold, because in an environment where there's ongoing demand, industrial demand, a general pickup in world demand, the demand for platinum might be better.